it's another video lesson. Today we're going to continue talking about inflation, but before we do that, I know what you're thinking. And yes, I actually did my hair today. I'm not wearing a hat. I actually look like a human being. Anyway, we're going to talk about causes and types of inflation today. And it should be a shorter video than last time. I think I rambled a little last time, so I apologize about that. We'll get to the point. So, the causes and types. Economists look at short term, which is what we like to think of as a few months to a few years, as well as long run inflation. So we're going to start by talking about long run inflation. Long run inflation, economists know what causes it. Long run inflation is caused by increasing the money supply, meaning that there's just more money out there. Tracking money can be, though, difficult because it's more than just the physical dollars that are out there, right? Because it also includes the money that's in your bank, interest that's paid on accounts, and more. So it's not just the dollars and coins. Economists like to use multiple definitions for what really is included in money. And we like to use what we call M1 and M2. M1 is the basic money supply. What M1 includes is those physical dollars and coins that are held by businesses like banks and consumers. How much cash is there really out there? Also, we look at checking accounts. So how much money do people have in their checking account? Not their savings account, but their checking account that they're actively using. And then things like checks. We also look at that. So that's all that's in M1. And as of a few months ago, October 2019, the United States M1 equaled about $3.9 trillion in money that's in people's hands and businesses and in checking accounts. Okay, it's a lot of cash. The expanded money supply is M2, so it goes beyond just M1. And one of the reasons why M2 is always going to be bigger than M1 is because M2 includes everything that's in M1. M2 also includes your savings deposits and your savings accounts, so things that you're like saving up for retirement would be included in there. Money market mutual funds, so things like stock market gains, as well as bonds and things that you usually hold on to for a long period of time. So those investments would be included in M2. So it's more long run money in M2. And if we take a look at people's savings accounts and stock market gains, as of April 2016, the United States M2 is about $15 trillion. So if we take a look at M1 and M2, and yes, you'll get a better look at these graphs if you're following along in the slides that I posted. In terms of inflation, we don't really care about how much is in M1 or M2. That $3 trillion and $15 trillion in M1 and M2 respectively really doesn't concern economists. What does concern economists is the rate at which it's changing. So the rate at which M1 and M2 is changing, that concerns us. Because if it starts changing rapidly, like as you can see with M2, not so much with M1, but a little bit in the more recent years compared to earlier, what you can see when there's a big change is that there's going to be inflation, right? If it's going to dramatically go up, there's a lot more money out there, and when there's more money out there, prices will go up. That's long-run inflation. Let's quickly talk about short-run inflation. Now, long-run inflation, we said we know what causes it. It's caused by a change in the money supply. Short-run inflation, we don't know exactly what causes it, but we can narrow it down to two different things. The two possibilities are demand pull and cost push inflation. We're going to take a look at both of those. Demand pull. Demand pull inflation means that aggregate demand is greater than aggregate supply. Now I'm throwing some new terms at you in aggregate demand and aggregate supply. During third quarter, we talked about just simply supply and demand. And we took a look at one product and we took a look at that product's supply and demand. For example, on the midterm, we took a look at Chick-fil-A sandwiches, and we took a look at their supply and demand. When we use the word aggregate, we're talking about the total quantity of goods and services. So it's not just one good, it's every single good in the economy. So think about the total demand of all the products and all the services that are out there. Are we demanding more of them, or are we demanding less of them? Think about right now during the COVID-19 pandemic. Demand is down. And if demand is down, well, we actually could be having deflation, but more on that in the next video. So aggregate demand, the total amount of demand of all the things that are in an economy. So we have price level, just like before, on the y-axis, and on the x-axis, rather than quantity, we have real GDP. So here we have our equilibrium of aggregate supply and aggregate demand, and what happens when you have demand pull inflation, where demand is higher than supply, we're going to shift our demand out. Ooh, animation, you can't get that in the slides because it's a PDF. So I'm shifting my aggregate demand out. What happens is my price level is now higher and my GDP is now higher. So because you have an increase in price from P to P1, and that's overall prices in your entire economy, because we're talking about aggregate supply and aggregate demand, that causes inflation, or that really is just inflation right there. This change right here, that's inflation, okay? Some examples of this would be things like Packers tickets, because you know I'm a Green Bay fan. From 1957 to 2019, the prices have gone up 2,045%. Oil, between 1998 and 2019, the price went up by 467%. One of the causes of an increase in the price of oil, actually in North Dakota, where they were making some new pipelines and new drilling in the ground, apartment prices went up by 425%, as a lot of people are coming in looking for jobs. And well, a small town in North Dakota, there's not that many, and they can't build them like that. The other type of inflation for short run is cost push inflation, which occurs when the price of your inputs, so things that go into that product like land, labor, etc., when those prices increase and the costs are pushed onto consumers. So once again, we have aggregate supply and aggregate demand. In this case, you still have P and Y as our equilibrium. But in this case, because the price of inputs has gone up, that means supply goes down, right? Because the cost of labor goes up and you don't want to supply as much anymore. Or the cost of inputs goes up, you don't want to supply as much anymore. So aggregate supply decreases, so we shift it to the left. And now I have a new price level P1 and a new real GDP at Y1. And once again, because I have an increase in the price here, that's inflation, okay? Now, one other little tidbit that you might not see in the slides, but you will get from the video today, is, well, what do you think economists would like more? Would they like this scenario more, or would they like this scenario more? The answer is that they want this scenario more, and this one, as a reminder, is demand pull. The difference here is that real GDP went up because we're demanding more. But if you remember just a couple seconds ago when we talked about cost push, real GDP went down. So would you rather have inflation where your GDP is going up, or would you rather have inflation where your GDP is going down? Obviously, you want your GDP going up, and you want people demanding more stuff in your economy. That means people have money to spend. That means businesses are doing well. This, probably not as much, but it still causes inflation, and this is the inflation chapter. So what are some things that cause this aggregate supply to decrease, to cause inflation? You could have things like an increase in the minimum wage, which then is passed on to the consumers, and that would cause inflation. Something like the oil embargo in 1973 and 74, where there were long lines at gas stations. The price of oil went so far up because of input costs coming from OPEC in the Middle East, and those costs were put onto the consumers, and supply went down. That would be an example of inflation as well. You can take a look at this slide on your own. It takes a look at the inflation annual percent change all the way from 1774 to 2007. And one thing you'll notice if you take a look at this slide is that the most common times when you have inflation in an economy, it's wartime. Wartime. However, it's going to be interesting to see what happens because of COVID-19. I mean, I just got it yesterday, my $1,200 from the government. You think if the government is giving every single person $1,200 and passing this $2 trillion stimulus plan, we're not going to have inflation? We could also have deflation. It's entirely up in the air, but it's interesting. Anyway, that's it for this video. I don't want to drag it on too long because you might look at the time and then be like, oh my gosh, I don't want to watch this, it's too long. So let's pause it. Hope you have a good one, and take a look at the assignment that goes along with this.